Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
Do you have a favorite band?
I'm a big country music fan, so.
Are you? All right. What style? Like
George Strait.
George Strait. I've really gotten into the old Outlaws, like Willie Nelson and those.
Yeah.
I love that.
First concert I ever saw was Willie Nelson.
Is that right?
Yeah.
Gosh.
16 years old.
Holy cow. Can you believe I'm from Austin, and he's in the area, and I've never seen him live, and that's a shame.
No, I didn't realize you were from Austin.
Yeah. I bring it up every chance I get on this show.
Well, I graduated graduate school in Austin, so.
That's right.
Yeah.
That was you were studying
Petroleum geology or sciences.
That's right. Yeah, you're a geologist and an earth scientist, right? Yeah. That's amazing. So country, I didn't realize that. So do you have cowboy boots and all that still, or no?
Sure. Yeah, absolutely. So, sitting right up there in the closet. Yeah. So
yeah.
Just saw Sam Hunt in concert a week ago. So.
Oh, awesome! Very cool.
Yeah.
Very cool.
But I did not wear my cowboy boots.
That's a shame. This is Trends with Benefits. I am Ed Lopez, and my guest today is Shawn Reynolds, portfolio manager at Van Eck. He also heads up the natural resources equity team, and natural resources is what we're going to talk about today. In particular, I want to talk about a couple of things that are in the news, the Inflation Reduction Act, and the whole energy transition theme, which has been a bit of a buzzword that we've all been talking about. But do we really know the implications of that, what it's really all about, and where the potential opportunities are going to be? So with that, Shawn, welcome to the podcast.
Thanks for having me.
As I teed up with the Inflation Reduction Act, is that something that you guys have been watching? Were you surprised that actually got passed?
I'm surprised it got passed the way it did, and it kind of the short notice that it did. We've been following Build Back Better, which this is a much slimmed down version of Build Back Better that has been talked about really since last fall, kind of ad nauseum. And they went through a number of fits and starts, and it looked like it was completely dead. And in fact, we were all sitting around on the Wednesday before this kind of officially became a real thing on that Thursday, and we're really getting quite frustrated that there wasn't something being passed, and so we were, just almost, gnashing our teeth, so to speak, that something hadn't been passed on the energy transition front, when it's really, the U.S. has really fallen way behind. So we were surprised, very, very pleased that it happened. It's a good start. It's a starter kit, so to speak. Good to see it happening.
There's, I guess, a few elements to it, but I'm going to focus in on the climate element, which was something like $370 billion allocated towards climate initiatives. I mean, that isn't a straight out cash give, though, is it? It's more credits and things of that sort.
No, about 40% of it is actually, tax credits, even a bit more than that. But the real big ones are the tax credits to the solar and wind industries that have been out there for several decades, and they've just been rolled every 1 or 2 years, those credits. And that's been a real difficult situation for developers to have, clarity, transparency of where these things are going. Now, I think most people have been operating like they're going to get rolled, but now this has been pushed out for quite, for a decade, for 10 years for many of the developers. And so that really is very useful for them. And that's the majority of it. There are a number of handouts there, but a lot of this is tax credits. And we can go beyond solar and wind and talk about, what's happening in carbon. 45Q has been around for quite some time. And 45Q is a tax credit related to carbon capture. They've expanded that quite a bit and made carbon capture and probably storage and sequestration, very economic for some industries. So we're heading down the right path, as we're saying.
Now, the number 370 billion by itself sounds like a big number, but is it really? I mean, in the grand scheme of things, is this going to move the needle for companies and ourselves in terms of our climate initiatives?
Yeah, I mean, again, broadly speaking, it's quite positive for the entire industry, right? But let's put it in context. It is a starter package. If you think about what's happening in Europe, I mean, they've got over $1 trillion approved. You think about what's happening in China, which is, I mean, we don't really know what the number is, but it's got to be on the order of trillions that have been invested well over a decade. And, this is basically just kind of a kickstart to hopefully catch us up to, some of our competitors and some of our friends are. We don't expect to see a kind of another round of this anytime soon, but yeah, you've got to start somewhere, and that's where we are right now, and that's how we feel we are with regards to this piece of legislation.
Yeah. What's the number, the big number that was it the International Renewable Energy Agency puts out in terms of what we need for, what is it, net zero? Is that the target?
Yeah, net zero by 2050. The amount of capital that needs to be spent in energy transition has been estimated. This is going back a couple of years ago. They said $110 trillion between now and 2050. Just recently, they've expanded that to about 125 trillion. Those are huge numbers. I mean, you can't lose sight of that. You put that into context of 380 billion. You're like, wow, there's a lot to go around the world with regards to investment. So that those numbers are going to have to get a lot bigger, and that's why we're really attractive to the energy transition space, and why we've made some direct investments and expansion of products into that area. Yeah.
What we need to spend to get there, I guess it's still really dependent upon government and policies getting passed, getting that support in order to get the funding and the spending for that kind of spend, right?
Yes. Yeah, exactly. And, and there's always this public-private partnership that's, you're always trying to find the balance of that. And I guess you could say that, China's on one side of it. It really needs to, it's very, very much coming from the central government. You got Europe kind of somewhere in the middle, and then U.S. on the other side. It's, really trying to, again, kickstart private investment and make private investment work, with as little as incentive from the federal government as possible. But one of the things that we've always said with regards to energy transition is you can't think about this as a typical industrial sector or industry, because it is being driven by more than economics. It's being driven by this urgency of addressing the environment, and that this belief that there's going to be a fundamental impact to Earth's environment and to the way that we all live, our way of life. That's going to go beyond economics, but that in itself creates a whole new set of variables that you need to assess when it comes to investment.
Yeah. So when you say it goes beyond economics, it makes me wonder. Okay, so obviously there's going to be some investment that needs to go to certain types of companies. Is there a profit story here? I mean, I got to imagine there is in some form or fashion, but I mean, if it's something that we need to do one way or another, how do you find where those companies are making money?
In a capitalist system, there's always got to be profits. And that's the role of government, in our view, is to kind of help, as we've said a number of times, kickstart this or provide the initial capital for it. So at the end of the day, so policy is huge, and it's just not central governments or federal governments. It has to go all the way down to the local side, because you are hearing lots and lots of great initiatives at a federal level, again, China, Europe, here, the rest of the world. But when it boils down, or trickles down to the local level, you're seeing lots of resistance. And because basically you have the not in my backyard syndrome taking place literally everywhere. And so you're really going to have to get this pushed down to the local level, where local communities are going to be very, very supportive of having, mines or processing or refining or storage, carbon storage in their backyard. It has to happen. And that's part of the issue that we're having with policy right now, is it's these grand, undetailed implications that the man on the street, the woman on the street is not fully aware of what that means. We're all for net zero. Of course, this sounds great. We want to save the environment, but what does it take to get there? It means there's some give and take. And that is, I would say, is somewhat disappointing with our policy right now, because we really don't think it's been comprehensively addressed or explained. Because the other thing, going back to the Inflation Reduction Act, it's great for solar and wind on these tax credits, but there's also a couple of very, very big misses in there. That's where we get a little frustrated. It's like, it's not comprehensive. This policy isn't really addressing the whole picture, which is really going very far upstream on this. And that makes the investment difficult. So policy is critical. That's number one. Number two is, when it comes to evaluating companies and investments and equities and stocks, it really comes down to the same thing. It's profitability, good companies, and really, really good management. That may sound kind of like an obvious issue is, great management. But environments like this, there's going to be a lot of management teams and groups and investment groups that try to take advantage of the situation. When you have trillions of dollars floating around, there's going to be a lot of people that are going to try to take advantage of it. What you really need is very thoughtful, experienced, capable management teams that are looking out 10, 20, 30 years from now. And so we spend a lot of our time really trying to evaluate the execution capabilities of management teams.
And going back to the Inflation Reduction Act, again, briefly, just, I know there was obviously mention of solar and wind in there. Do you see certain types of companies in particular that would benefit more directly from this particular bill?
We really think that the long-term benefactors of the whole energy transition are really kind of like the picks and shovels story. It's not necessarily developers, because there's a lot of competition out there with regards to developing renewable energy sources, be it solar, wind, nuclear, and hydrogen. But and then you even think about where EVs are. Everybody loves to talk about Tesla, but coming clearly fast behind them are the traditional OEM automobile manufacturers. And so the competition is going to drive the profitability of that down. So it's really going to be the component manufacturers that we're excited about. And also, again, moving very far upstream is, you got to start with the minerals. And so, we see that an area of real growth is going to take a huge amount of that capital of 110 or 125 trillion dollars that we talked about. It's going to take a lot of that.
Yeah. You bring up a great point and a great transition to the energy transition story or discussion. And really the big question I have for you, we as a society, are we swapping one problem of burning fossil fuels for another of digging up a bunch of minerals and metals?
Absolutely. And it's again, that trade-off that we mentioned, and it's a sense of urgency. Which one do you need to face first? Let's be honest. I mean, there's a catastrophic scenario, or many catastrophic scenarios out there with regards to the atmosphere and greenhouse gas emissions and the effect on humanity on Earth. There's not a catastrophic scenario with regards to digging more holes in the ground. All right, so at this point, so you got to address things that that are more urgent. But the reality is, you make a great point. The industrial age is really powered by fossil fuels. We are have to make a massive transition away from fossil fuels towards metals. Now, the interesting thing, what we don't think is fully understood by most people, is that this transition, just how big it is and how geopolitically primed it is. All right, so if you think about fossil fuels, the United States now, we are the largest producer of fossil fuels in the world. That's oil, that's natural gas, that's coal. You go back to the 1970s, 60s, early 80s. We, after oil embargoes from the Arab nations in the 70s, we have been trying to wean ourselves off of that for 50 years. And because of the technological success of shale and horizontal drilling and hydraulic fracturing, the United States went from, just call it roughly, they doubled oil production over the last decade. Roughly, it went from a little over 5 million barrels to something over 10 million barrels. That's fantastic, and have gotten ourselves to a situation where we are essentially energy independent. And you don't have to look any further than this second today. Look at what's happening in Europe. Look what's happening even in China, and realize that even though natural gas is selling at $9, we're buying gasoline for now under $4 as on an average on a national basis. But you look at Russia's impact on what's happening in Europe, and they're paying $60, $70, even $90 for natural gas. They're paying $20 a gallon for diesel. It's a huge impact and a huge benefit to this country. But the move towards energy transition, we're kind of giving that strength, that geopolitical strength, that economic strength away by saying we're going to move very aggressively into energy transition. So to put that in context, we're very worried about OPEC, very worried about Russia. You put OPEC and Russia, OPEC plus together, that's roughly 40% of the global oil market. So, we're very concerned what they're doing. But if you think about OPEC plus Russia, OPEC plus, you're talking about, 27, 30 countries, that make up that whole consortium. When we think about metals, and we think about all the critical metals that go into energy transition, things like cobalt, lithium that many of us heard about. You can't ignore copper. You can't ignore nickel, how important that is. Rare earths, graphite. That is all mined around the world in different sources, in different locations. But predominantly, most of it goes to China to be processed and refined into intermediate or final goods. And if you think about market share, you even go as far down as nickel. 35% of all nickel goes through China. Then you go to things like, rare earths and graphite, and, upwards of 80 to 90% of those minerals go through China. And you can't have energy transition without those minerals. And we're putting them in the hands of one country that doesn't necessarily think likewise to us. We think about all the issues. We fought wars over Middle Eastern oil. What's going to happen when we kind of get to a point where, somewhere between 70 to 90% of the critical energy infrastructure or energy minerals are dependent on China? It just seems to be a huge risk that isn't being fully dealt with at this point. And that's where we kind of think that we talked about the IRA, Inflation Reduction Act, there's a couple big misses in there. We don't really think they've addressed that nearly as aggressively as they need to.
Yeah, do you think that's the whole NIMBY aspect, not my backyard? Because you're going to need a lot more mines locally to get the supply you need, right?
Exactly. There's the NIMBY issue, and there's also just the fact that to do the exploration and to do it quickly, we talk about in a lot of different countries. In this country, that there's a certain amount of automobiles that are going to be zero emission by 2030. Well, the fact is, permitting mines in this country right now takes upwards of 5, 6, 7 years. If you start right now and you're trying to get a mine permitted and it takes you 5 years, even if it gets accelerated, say it's 3 years or 4 years, and then you build the mine and you start producing it, all of a sudden you're in 2030.
Yeah.
So that's why we kind of think this piece of legislation missed a little bit. Missed a lot, because this is going to be a big issue. Because the other thing about the legislation, there was a lot of headlines around the benefits to electric vehicles. All right, and the actual discount that you'll get or by buying electric vehicles, but those electric vehicles have to have domestic content and domestic labor. Well, the domestic content, all the way down to the battery, there is not an electric vehicle in the world that doesn't have some sort of content, of significant content, say 10% plus, coming from China. So I'm not sure how that helps anybody until you actually get to the point where you're creating all that content. It's got to be from soup to nuts, and it's just not in this bill as it stands right now.
You've told me a stat once before, which I just thought was amazing, which was the metal intensity in an electric vehicle. What is that relative to a traditional combustion?
Yeah, it depends on the EV, but it's anywhere from 5 to 8 times more metal that's in an electric vehicle than an internal combustion engine car. And I always kind of like the visual of like driving down the highway and thinking that every car that I see has 5 times more metal in it. It's staggering. And that's how you get to that point where I was saying earlier that, so much of that metal processing and refining and final, kind of finishing takes place in China. And that amount of metal first has to be accessed and then, as I say, eventually processed. And you're really handing off the security of that supply to China.
With the metal intensity that is required and just the amount of metals that are required for electric vehicles and renewable technologies, when you process these metals, isn't there a lot of chemicals that go into it? Is that a concern also then for the environment? So then are we giving up, emissions for chemicals that leach into the earth?
Yeah, that's a little bit of the give and take, but there's also just, needs to be, regulated to the point where that just doesn't happen. I mean, there's a little bit of chemical use in the processing of many of these minerals. The waste that they produce is actually quite toxic, but it has to be dealt with, and that has to be worked into the economics. So when people think, you hear these numbers like, oh, this is the cost of producing or processing XYZ. They don't always take into account, say, the emissions abatement that has to happen when they're actually mined and accessed, and they don't take into account the back end of dealing with the waste and residue or recycling needs and dealing with it. And so, you need to think about these things in a very holistic manner when you really come down to the economics and the costs.
Do portfolio managers like yourself look at that in terms of management's practices there and look at that as perhaps as a potential risk factor if they're not doing things appropriately?
Yeah, we certainly do, because we always use this kind of statement or this comment that sustainability requires sustainability. If you want to make a sustainable impact on the earth or on the environment, you better have a sustainable business model that's around and can generate wealth for its investors, for its shareholders. Because if not, the company's not going to be around. And we've seen many iterations of this. This is going back several decades of companies who had great aspirations. All management teams and companies have great aspirations. Whether they're able to execute and survive that and be a sustainable company is another question. Do they really think about the long-term economics of their business, of their strategy? And that's the critical aspect, because if they can't continue to be in business, they're not going to help in any way. And so that's what you have to look at. And so that's why you have to look at the full life cycle from soup to nuts of these different technologies. You just can't take the little picture and say, oh, this works for the next 3 years, 5 years. You really need to think about going from mineral to final good.
Sounds like a classic supply demand issue where there's going to be a lot of demand for renewable technologies and therefore for a lot of metals, which currently have a supply constraint on it.
Yeah, absolutely. And we also say, you can't decarbonize demand before you decarbonize supply. So, you've done that, right? You basically, have people, much greater demand for all energy transition technologies than you do supply at this point. In that case, it's absolutely a classic supply demand scenario. And eventually, we think it will get fixed. We just don't think that's, it's not going to happen easily. It's not going to happen quickly. And it's not going to happen cheaply, and I think the easy part, the not easy part is definitely the resistance, the not in my backyard, the kind of the incoherent policies that are being thrown out there, and a poor understanding of kind of of what really has to happen to get to that net zero. It's not going to happen quickly because, again, not in my backyard, but the permitting issues I was talking about, and just the fact of building any of this stuff, it does not happen overnight. We talk about we can't get enough employees to work at our restaurants, let alone getting people to work at mines, to work in construction and manufacturing, and the fact that we have to build up multiple new industries, and how these people have to be trained. That takes years and years. And then just in terms of constructing a new mine, again, get through the permitting, which we talked about, is years. Constructing that mine is, again, years. We're still a long way away from hitting our stride with regards to that.
What about some of the U.S. E&Ps that you cover? How are they thinking about the energy transition?
I would say most of them are looking at the transition period really as one of mitigation. So, trying to limit their impact on the environment through really focus on methane, which comes from the natural gas. It comes from associated natural gas and oil, and flaring. We've heard about methane emissions and flaring, and really trying to reduce that. And that can make a huge impact. I mean, a gigantic impact. It already has, but they're just taking it to another level. And so I think that's really how the traditional E&Ps are participating in it. Eventually, you can see the E&Ps looking into underground storage of carbon, and there's a few that do that. But that's where I where they are and where I think you see them going. The integrated oil companies, on the other hand, are really moving very, very definitively down the transition track, which, I mean, many of us have heard about this. I think if you really try to focus on what's happening in Europe. You look at BP, you look at Shell, you look at Equinor. These are companies who are really moving down that way very, very quickly and are going to be, they're not necessarily leaders, except for maybe Equinor, right? At this point in time, Equinor is probably a leader in offshore wind and offshore storage and sequestration of carbon. In terms of solar and wind is a broad issue. In terms of hydrogen, they're not there yet, but they will eventually. They have the capacity, they have the management capacity and proof of concept in many cases to really pursue these gigantic projects. And so when we really think about who's going to be the leaders in some of this stuff, we believe it's going to be some of these international integrateds.
Have they just realized that they need to move in that direction?
Yeah, I think the senior management teams would basically say, "Hey, we're not an oil and gas company, we're an energy company." That's would be the statement right now. And so we're going to generate energy however we can, however we can be profitable, and however needed, however what's demanded. So I think they're looking at it from that perspective.
I wonder if I could talk to you a little bit about or ask you about inflation and commodities. I've heard you before talk about that we're in a new commodity bull cycle. As we speak now, we're talking in August of 2022. It seems like commodities have come back a bit. Inflation seems to be subsiding. What's your take now?
Well, it's level versus trend, right? So inflation is trend. Prices are undoubtedly high. I mean, natural gas, we talked about that earlier, around the world is all-time record high. Here in the United States, right here as we sit today, we are at 25-year highs, which is basically, since records have been kept, 25 years high for natural gas in the middle of August. Does it go further from here? Perhaps, but that's a real impact on you, me, on the economy, on the economies around the world. Is inflation coming to a pause or to is it moderating? Absolutely, because we how much further can we go in terms of some of these prices, whether it's energy, whether it's food and ag products or minerals. It has to stop at some point, and it feels like it is pausing there right now. But again, there are many other drivers out there that don't seem to be just temporary, which is what I would say we're going through right now is a temporary pause. I mean, you think about gasoline prices in this country undoubtedly are being impacted by the release of the Strategic Petroleum Reserve. That's 100 million barrels, basically over 100 days, that's 1 million barrels a day on a 100 million barrel a day market. I mean, that's huge. That's gigantic. We're also seeing, we're sitting here at $90 a barrel for WTI roughly, in the face of a huge recession, happening in China. I mean, it's not talked about a lot, but it's clearly happening. We're sitting here at $90 oil with a recession happening in Europe. Again, not necessarily technical, but there's no doubt that it's happening. So there's gigantic demand destruction going on around the world. And maybe it can continue for a while, but prices are very, very resilient in the face of all this. And that's because supply is, as you mentioned earlier, it's a supply-demand story. Supply is really struggling to keep up.
What's one long-term trend you see playing out over the next year or several years?
I think it's probably obvious that I just think that the very far upstream mining is going to be very robust over the next decades. I don't think it's going to happen in the flash of the pan or, the very quick fashion that we've gotten used to with regards to some of these trends because of the issues that we talked about with not in my backyard policy, permitting, just building of mines. But I think you mentioned earlier, and we talked about earlier, like this, we're not talking about thousands of mines. We're talking about tens of thousands of mines that have to be developed over the next 10 to 20 to 30 years. That's going to take a lot of exploration because a lot of it isn't known where it exists right now. And then it's going to take a lot of development and then actual mining. So that seems to be real exciting. Really think that hydrogen is going to be the long-term success story of energy transition, primarily because a lot of the infrastructure is there. Hydrogen can go into natural gas pipelines. Hydrogen can go into, LNG tankers. Hydrogen can be liquefied. Hydrogen can be moved, can be turned into ammonia and put into tankers and moved around the world. So a lot of that energy infrastructure is there that will help hydrogen in a huge way. It's a ways away from its economic viability, but its long-term applicability, it looks like it could be the winner.
Great. You ready for trend or fad?
Sure.
All right, this is our speed round. You can explain your answer if you want, or you don't have to. This is I'll mention a few different concepts and just ask you trend or fad. Growing dividends for energy companies. Trend or fad?
That's a trend, but I wouldn't say growing continuously. There's a limit, right? So, but I think you're going to continue to see a high level of dividend and capital return from the energy industry for quite some time. This is a major pivot in their strategy when it comes to their finances and their shareholder returns.
Vertical farming, trend or fad?
I think it's a trend, but it's going to be, it's going to take a while.
Buy now, pay later options.
I just say fad.
It seems like it's creating a new potential debt problem for consumers. And then finally, 80s hairstyles, trend or fad?
Gosh, let's hope it's a fad.
Yeah, let's hope. I swear to God, though, I saw a couple of guys walking around the street, not together, two separate incidents, had the 80s metal hairband look going on. I'm like, is that coming back? I was like,
yeah.
Shawn, this is great. Thank you very much for your time. I really appreciate it.
Yeah, thank you. It was a lot of fun.
And if you want to hear more from Shawn and what he and his team are up to, visit vaneck.com for blogs, videos, and the like. And with that, I will say thank you for tuning in to another episode of Trends with Benefits.